Hi, welcome to Unit 1. As we go into cost accounting, the first thing we want to do is clarify the difference between financial accounting and cost accounting. Financial accounting is generally known to focus on money or finances, and cost accounting generally known to focus on operations. And the other differences can be signified or differentiated between your audience and the type of reporting. With financial accounting, your audience tends to be your senior management and those outside the company, such as your creditors, your investors, or your owners. Then your audience for cost accounting, or cost accounting is also known as managerial accounting, but we're going to continue to call it cost accounting since that's what the course is. And your audience for cost accounting tends to be your business department managers or other individuals that are running functions inside your company, middle management, and then high level or senior leaders sometimes want this information, but it will usually be at a high level summary, such as just your product line costs and cost versus sales, but they don't want down to the detail levels such as cost of goods sold, weekly productivity, inventory levels by part, or that type of information that your department managers will need, or the various managers or various supervisors will want as they delve into the individual departments, product lines, costs, job costs, those types of details. Then providing this information will be the various reports, and those also are different between financial accounting and cost accounting. With financial accounting, the reports are pretty standard, and if you're a publicly held company, they are mandatory. The standards are established from GAAP, which is generally accepted accounting principles. You have your balance sheet and your income statement. The format is pretty standard, no matter the size of the company or type of company. And I believe in financial accounting, you would have put together these statements, and so you should be familiar with the formatting. The timing is standardized. They would be monthly and annual between the sizes of companies and organizations. And if it's a publicly held company, quarterly statements would also be required. And if it's not a publicly held company and it was a very small company, the owners could dictate the timing. If it's very small, they may not do a monthly balance sheet. They may just make sure accounts tie out and then just do a P&L, which is another name for an income statement, a profit and loss. That would be dictated by the owners. And then the level of detail and content, that's also dictated by the owners. And when I say owners, the difference would be between a publicly held company and actually the detail and content, formatting, timing, that's all actually dictated by the SEC, the Securities and Exchange Commission. And then any company that is not publicly held, the owners would dictate that. Which those would be privately held corporations, partnerships, or smaller organizations that could be held individually owned. And I say owners can dictate it, but if they are leveraged, they have loans taken out, and so their creditors could also dictate the type of financial statements that the creditors want to see. So there is there might be some requirements other than what the owners want and the level of detail that's required. Then with cost accounting, the reports are completely different from company to company or in type of company. There's no standard in formatting of reports for cost accounting. Every company is going to be different, every type of organization, every type of industry. Each format is, the requirement is for the specific need, the specific decision or situation. You might see from company to company some similarities because if you have a job, you want to know the cost per job, you're going to see that you have your labor, your materials, and your overhead. And so your formatting might be the same from a job cost making moonwalks to job cost making airplane starter generator to your job cost making a widget. So those formatting of a report might be similar, but there isn't a standardized form such as a balance sheet showing assets and liabilities and capital on assets on the right and liabilities and capital on the left. So your format for any of your cost reports can be different however the company wants them done. And the person or managers requiring or requesting the reports are going to dictate how they want them done, or they're going to say, I want this information, and then the accountant putting together a report is going to put it together in the format they want it. The timing is also going to vary. You're going to have regular monthly reports. Then there are some reports that you might do weekly. Sometimes you have productivity reports that are done on a weekly basis. For instance, I've worked for a company that had the productivity showing the employee productivity for a certain product line every month or every week. This can be useful if you add a different product line, so you can watch the productivity. Is it better or worse than your productivity on your other product lines? Let's say you have slower productivity, then you can review your process to see, is it just a learning curve, or do you need to revisit your process and look for more efficiencies? Or is this new product line just going to be a slower process? So sometimes the weekly reporting is useful and necessary, or sometimes it's not, and that also has to be revisited as well. A lot of the cost accounting reports are often need to be reviewed every 3 or 6 months to see, are people really using these? Are they providing value? And if not, then let's not do them. And then what information do we need to provide that would add value? And I can tell you from a lot of experience that that is a good exercise to perform. And often, if you ask those questions, and every time you ask those questions, yes, I use it, yes, I use it, yes, I use it, then another method is don't provide it. And if you don't provide it, and the next month you don't provide it, and you don't get it yelled at, and you don't provide it again, then no, it's not being used. And when I say don't provide it, I'm saying that you do that with caution. You do that with the whole accounting and your manager's awareness and approval, and make sure they have the understanding why. And you don't do this with every report. A lot of times we have a good idea of what's being used and what's not. You're not getting questions on this report. You haven't been questioned on it for a year. And this isn't a focus of attention. So you have a good idea. So that's another way to also do that question, per se, without actually asking the question. A lot of times people don't like change, so they'll say, yes, I need that report, when they actually don't, because they're afraid of change. Another difference with timing is future. with cost accounting or reports, a lot of times we're doing forecasting. With purchasing, you have to do a purchase order and place a purchase for products or parts out in the future. Some parts have long lead times, so your purchasing department has to place an order for parts for 3 months out, maybe 6 months out, or some parts even a year out. So your cost accounting reporting would include forecasting what your productivity would be for 3 months out, 6 months out, or a year out. So that would assist your purchasing department in placing their orders. It could also help with planning your employees and your HR staff with staffing. Do they need this product line staffed with 8 headcount or 10 headcount? Can they move 2 people from this product line to that product line? So a lot of times you'll have your forecasting or future reporting that you won't see in the same type of reporting in financial accounting. Both types of accounting, you do budgeting, and they're impacted with budgeting, but I'm talking about a different type of reporting with your forecasting. You'll have some sales forecasting, that's impacting your cost accounting because you need to know how many parts you need, and that's affecting your inventory reporting and your headcount, staffing type reports. You also have a lot more variety of your level of detail and the content that are in your reporting. You don't have the SEC dictating what is required in your reporting. Your owners are not dictating what they want to see in the reporting. You have every manager from every department saying what reports they need. You have supervisors from different departments saying what reports they need, what information they need in these reports. And you are reporting on many different factors. You're reporting on types of inventory. You're reporting on the total cost, which is inventory, your labor, your overhead together. You're reporting your overhead, which includes so many factors. All your expenses that aren't related to productivity or aren't related to your products or your service, whatever your income is from. Then you're reporting all your employee costs and your direct labor costs. Then you also have your sales. So you have your sales compared to your costs, so that you have those reports. The detail and the content of the reports necessary for cost accounting are going to vary so much more than your standard financial accounting reports of your balance sheet, your income statement. Then you do have a statement of cash flows. So you're going to have a lot more reports required for your cost accounting. Now, do realize that both functions are very important, and both functions rely on one another. Your cost accountant cannot get their job done without the financial accountant. Cost accountant will need the information from your financial accountant because your financial accountant will pay your payables invoices, your vendor invoices. So the cost accountant needs the cost of the inventory that came in, which is on the payable invoices. The cost accountant will need costs of payroll, which would have gone perhaps from the HR department, or financial accountant would also be responsible for payroll. So the cost accountant would need that information. And then also need to know expenses that aren't related to productivity, which to go to overhead costs, they'll need that from the financial accountant. So they need to know information that the financial accountant has. And in turn, the financial accountant will need to know information from the cost accountant, because the financial accountant will need to know the cost of goods sold, the cost of inventory. And that information will be required for the income statement. It's required for the balance sheet because you carry inventory on your balance sheet. They'll need to know what inventory whether it went up or whether it decreases. So both of those roles are just as important as well. There's not one that's more important than the other. And they both are key to the successful production of the financial statements. Even though the financial accountant might be reporting the financial statements, they cannot do it successfully without the information from the cost accountants. So in those organizations that have cost accounting, which would be manufacturers and some service organizations, then those areas are just as important for one another as those both are just as important as each other. There's not one more important than the other. I hope this illustrates the differences between the two. If you have any questions that I can help further explain the differences, please reach out to me. If you have any questions about anything else, please contact me. You have my email, you have my phone number, both on the syllabus and the introduction. And I look forward to speaking with you further in the session. So good luck this week, and we'll talk to you later.